Hello, welcome everyone. It's Wednesday afternoon, but it's Wednesday early morning in the US, and obviously they're still counting their votes, but obviously Trump is yet another US president for the second time. It's a good opportunity to talk about how the new US president and his administration is going to affect the Asian economies, including the Hong Kong economy. But obviously, today's talk is based on a report published by the IMF with a team led by Dr. Johannes Wiegand, who is a seasoned macroeconomist as well as economic historian. He's going to talk about, obviously the risks and opportunities in this region with some of his forecasts about the economies in the Asia-Pacific region. There will be Q&A, and I'm sure there will be questions about geopolitical risks, supply chain restructuring, and many other interesting topics. So without further ado, I'm just going to introduce Dr. Wiegand very briefly. He has been an economist at the IMF for many years, used to work in the research team, and now leading the team studying the Asian Pacific economies. And I'm Hayward Tang, the director of the Asia Global Institute, and I just told Sally Chan, who is once again the head of the IMF representative office in Hong Kong, and we have been longtime friends, and she has been supporting AGI for many years. And I told her November is a busy month for a lot of organizations in Hong Kong, but we have been very selective. We only chose the best people to speak on our platform in November. Otherwise, we will be busy doing events every day or every other day. So let's take a group photo with IMF representatives who flew all the way from Washington, D.C., and also special guests to come to the stage. And then after the group picture, Dr. Wiegand is going to give a half an hour presentation. All right.
Okay, left hand side. Left hand side, okay. For one step. Yeah, thank you. Please go, sir. Yeah. Okay. 3, 2, okay, sorry. 3, 2, 1. Okay, one more. Okay, 3, 2, 1. 3, 2, 1. 3, 2, 1. Okay, thank you.
Thank you. Other way, yeah, just stay here. That's how it Great. Okay, thank you very much. Thank you for the introduction. Thank you for the invitation to this very impressive venue and very impressive audience. So as I said, my name is Johannes Wiegand. I'm the head of regional surveillance for Asia and Pacific at the IMF. And as was just explained, we prepare a report twice a year, the Regional Economic Outlook. And I will go with you through this report. The report has two parts. The first one is our sort of standard overview over developments in the region, outlook, risks, and policy discussion. But then we have a second part, and that's sort of a more analytical part, where we look at a specific topic. And the topic we have looked into this time is structural transformation in Asia and the future of the Asian growth model. Sally explained to me that this audience may be more interested in the second part. So I will go through the first part relatively quickly and then spend a little bit more time on the structural transformation bit. All right, so part one, Regional Economic Outlook. I just skip through that and go straight to our chart. So first is recent economic developments. The chart on the left shows how growth has been in Asia in the first half of the year relative to our forecast. On the left-hand side, if you see that a dot is above the diagonal line, it means that growth was stronger than we had forecasted earlier in the year. And you see that by and large, with a couple of exceptions in most Asian countries in the region, growth in the first half was stronger than we had projected. So that's why we say there have been upside surprises in the first half.
The right-hand side shows the contribution of different components to economic growth in the region. Maybe a couple of things to take away from that. The yellow bit is net exports, so exports minus imports, and in almost all of Asia that contributed positively to growth in the first half of the year. In the long term, that averages out to zero, so that means net exports were a significant component to growth in the first half of the year. And maybe also to notice that in advanced Asia, that really was the key component that grew. While in emerging Asia, sort of growth was not only stronger, it was also more broad-based and resilient. Very briefly, also on the components on growth, we looked a bit what's behind the strength in exports, and it seems that this is not uniform across countries. For example, Asia exported especially to emerging markets. Strength in exports was to emerging markets, the demand from abroad, and less so from advanced economies. While, for example, in the Asian economies, you see that export growth was relatively broad-based. On the right-hand side, we look at domestic demand, and I think the one takeaway from the right-hand chart is that in advanced Asia, outside Japan, domestic demand was quite weak in the first half of the year. Countries like Korea or Australia, and that probably reflects the delayed impact of monetary tightening in these countries. In emerging Asia, however, domestic demand was also fairly robust. Let's go to inflation. Of course, as you all know, the entire world has gone through a large inflation cycle post-pandemic. And the takeaway here is that Asia disinflated very rapidly and faster than other regions in the world. And basically, disinflation in Asia is complete by the middle of this year. It was already complete for emerging Asian economies by the end of last year, and this year we project actually the lowest inflation rate in 25 years for emerging Asian economies. In advanced economies in Asia, inflation was held up for a while by higher services inflation that very often reflected wage pressures. So workers tried to compensate for the real income losses they had made during the inflation years, and that pushed up services inflation, which has a large wage component. But also that actually has come very rapidly down in the past couple of months. A couple of external developments, and these are certainly charts that we will need to update by the end of the week. The first one is on exchange rates. In the first half of the year, many Asian exchange rates were still under significant pressure and depreciated. That you see in the green bars. Then this suddenly changed in July, August, when suddenly there was a weaker US data and a sudden and very abrupt change in expectations about policies by the Federal Reserve going forward. Suddenly Asian currencies appreciated very rapidly. Then in the last month they have again lost some ground vis-a-vis the US dollar, and I understand today that has continued. Another external development that for us from the fund side is very worrisome is trade restrictions. You see that in 2024 promises to be a record year in terms of trade restrictions imposed across the world. I get back a little bit later on why we consider this a dangerous development. So what's the outlook? If that's the table that the press always wants to see, that has all the growth forecasts for several Asian economies. Maybe for you that's slightly less interesting. The main part is we have upwards revised growth for the region slightly, both for this year and for next. For this year, that reflects mostly the strong performance in the first half of the year that carries over in full year figures. For next year, it mostly reflects that inflation has come down. Therefore, there's no scope for monetary easing in Asia, and we expect more accommodative monetary conditions than we did previously for 2025, leading to a slight upwards revision for growth in 2025. What we also like to say at this stage is with this, Asia contributes 60% to global growth, as it has in previous years. The GDP share of Asia is slightly above 40%, so we always like to use this to demonstrate Asia really remains the engine of global economic growth. Our forecast for inflation here, you again see how rapid disinflation has been in emerging Asia. It was really already complete by the end of this year. It wasn't complete in advanced Asia, but now it is also complete there. And actually there are a couple of economies which you see on the right hand side where actually inflation is uncomfortably low. and where I think central banks would like to see higher inflation. One of them is Thailand, and the other one is China. Rest to the outlook. I go through all this relatively fast because I said I won't have time for the second part. We flag a few risks in our Rio. Some of them have maybe been accentuated by today's developments. One is potential for weak external demand. That, of course, would be, is quite negative for a region as integrated in global supply chains and dependent on exports as Asia. So we see that some forward-looking indicators actually point to the downside. The other one is market volatility. That became a topic really in July, August, when expectations about Fed policy changed rapidly, and you had for a day or two very especially rapid unwinding of carry trades with the Japanese yen as funding currency, very sharp appreciation of the yen, temporary sell-off in stock markets. Stock markets recovered relatively quickly. You see that sort of overall market volatility after this initial bout has sort of come down again to more modest levels. I don't know what it is today. But currency volatility in Asia has remained relatively high. And volatility by itself, of course, is not necessarily a risk, but it is a risk if it affects confidence, if it affects investment decision, if it affects consumption decisions. One persistent risk for the last 3 years has been China, as you all know, probably much better than myself. There's protracted adjustment in China in the property sector that has been weighing on domestic demand. It has also been weighing on prices. There are strong disinflationary pressures in China, partly also on export prices. We did some analysis actually in our previous Rio that showed that this actually spills over into neighboring economies, especially those with a similar export structure, and therefore can be a cause of negative spillovers. But of course, China can also be a source of positive spillovers. That affects one spillover you see on the right, that is recovering tourism in China to neighboring countries. That, of course, is fed by stronger domestic demand. And I think a policy point that we've made consistently at the fund is policy measures in China that strengthen domestic demand, they are part of the solution. Policy measures that increase capacity, production capacity without strengthening domestic demand, they are problematic because they could lead to further downward price pressures and to frictions with neighboring countries. Here, again, we look a bit at trade. So trade patterns have shifted quite significantly in the past 5 years. That certainly relates to geo-economic fragmentation. So China, for example, exporting much less to advanced economies than it used to, and exporting much more to emerging economies. The ASEAN 10 countries, by contrast, exporting more to China and the US, and that is probably because they're kind of bridge countries. So some trade targeted by tariffs from the United States or from China has been picked up, is channeled through third countries, some of them in Asian economies. We did some empirical analysis on that, and we see that there's a strong, significant effect. So goods targeted by tariffs, the exports of these goods from Asian countries have increased by more than goods not targeted by tariffs, which shows that how trade policies can redirect trade flows. And overall, these are economic costly detours, right? So part of trade is channeled to third countries that previously would have been exchanged directly. That comes at a cost to the global economy. Policies, very briefly on macro policies. The bottom line is fiscal policies in Asia are too loose and monetary policies are too tight. And it's time to rebalance those. Fiscal policies are too loose because you had large increases in public debt and during and after the pandemic, and basically debt ratios have not come down since. In several countries, that means higher interest costs going forward. That means less fiscal space to address issues like, for example, climate change or demographics. And we also see that fiscal consolidation is constantly falling behind plans every single year, and 2024 is no exception. And we talked about monetary policy, how inflation basically is defeated in Asia. Our advice would already have been half a year ago that many Asian central banks should cut policy rates. They were reluctant to do so, partly probably because they feared about the external value of their currencies if they did so. But with now also the Fed expected to cut, that constraint should be less than it used to be half a year ago. And a couple of other risks. One is risk to financial stability. We did some analysis that shows that the monetary tightening from 2021 to 23 is still feeding itself through balance sheets. So the full effect is not reflected yet everywhere. And that means that financial supervisors need to be vigilant for pockets of vulnerability. One, for example, could be household debt, which basically has not come down relative to 5 years ago, if anything increased. And another medium-term risk is climate change. Some of the most vulnerable countries to climate change in the world are in fact in Asia. And that has all kinds of policy implications, but I will not talk through that because I think I'm going to spare time for the second part that we do in the analysis. So again, this is on structural transformation and the future of Asia's growth model. Brief overview. Left-hand chart shows how GDP per capita in Asia has not only caught up, but is now above the average of the rest of the world. On the right-hand side, you see poverty ratios, how they've dramatically declined in Asia, even in low-income countries in Asia. And you could probably say the last 30 years in Asia have been maybe the most spectacular development story in human history in terms of accumulation of wealth, in terms of improvement of living standards. And in this chapter, we look a little bit more into what have been the factors driving this and what is the outlook for these factors going forward. Yeah, and I will get to all these points during my presentation. So maybe I skip through this and come back to that when we look at the slides. So the first one is a decomposition. That's a standard decomposition economists often do of GDP growth into several components. And it looks at what has been driving GDP growth across Asia. And I think what you see is there are three main factors. One is productivity growth. The second one is human capital accumulation, so more years of education, better educated workforce. And the third one is the employment population ratio. This is basically demographics. So demographics giving a positive impetus to growth in Asian economies. There are some differences across countries. Yeah, for example, you see that in lower income countries, capital accumulation still played a very important role in growth in the past 30 years, while in advanced economies that's less the case. But this is standard economic theory. So at the beginning of development, capital accumulation investment is a very strong contributor to growth. Once your capital level is satisfied, the future growth comes less from capital accumulation, but more from the quality of capital, so from productivity growth. One component that is worth looking into more closely is indeed the employment population ratio, so demographics. So why has the number of people employed increased relative to the overall number of the population? And there you see that in different country groups, different forces were at work. So in emerging Asia and in low-income countries, it's very much because the working age population has been growing over the past 30 years. So these are young countries, or used to be at least young countries, that where more people went into the workforce. In advanced Asia, actually, there has been no contribution from that. And the entire contribution has been from labor market participation. For example, higher female labor market participation than 30 years ago. Now, what's the outlook for demographics? The left-hand chart shows you two things. First, every country above the horizontal line, which is every country, will see that the old age dependency ratio will increase. Yeah? And that means that actually is a headwind. So populations will age, fewer people will work relative to the overall population. In some countries, in many countries, in absolute terms, the working age population is still growing. So these are the countries on the right. On the left-hand side, the population is shrinking, the working age population. And that gives you some indications about potential pressures, for example, on fiscal balances, on social security systems. So these countries on the left probably can expect quite significant pressures over the next 20 years. Then on the Right-hand side, you see, before I show the growth decomposition, this shows a projection about growth. Overall, we expect, if you extrapolate the trend that we observed in recent years, for the next 20 years, we observe growth in Asia to fall from about 4% per capita today to about 2% in 2040. And it's really driven by all components. So less capital accumulation than before, slower productivity growth, and also a small negative contribution from the employment ratio. Let's look at the employment ratio in more detail, and there you really see quite significant differences between countries. I think it's very worthwhile to look at this part. So the countries that are labeled old are the ones where you saw that the absolute working age population is decreasing, and there actually you get headwinds to growth from demographic developments, and quite significant ones. In countries that are still young, you still get the tailwinds to growth from demographic developments. The slide on the right is similar to the one on the previous page, so I will go through that. So this was the demographic component. So in many countries, headwinds to growth from demographics. Now what about productivity growth? Yeah. So what's the outlook for productivity growth in Asian economies? And productivity growth can be driven by two things. One is general increases in productivity within sectors, and the other one is that people and production moves from less productive to more productive sectors. That we call structural transformation, the movement between sectors. The chart on the left shows that structural transformation in Asia has been huge. So in 1990, more than half of the workforce in Asia still worked in agriculture. Today, this is about 30%, and much of this population has been absorbed into manufacturing. I think that's a quite traditional story that many people associate with Asian development. But not only manufacturing or industry, also services. Employment in services has grown quite rapidly in Asia. And you see what has driven productivity growth. You see that in the emerging economies and in low-income countries, structural transformation really has been a very significant part of productivity growth, and therefore of overall growth in Asian economies in the past 30 years. In advanced economies, less so. And the reason for that is fairly simple, because in advanced economies there hasn't been a lot of structural transformation in the past 30 years. The agricultural sector was already small in 1990, so there was little scope for people to move from agriculture into other sectors. But in emerging markets and in low-income countries, this has been very significant. Okay, let's look a little bit closer then at the pattern of structural transformation in Asian economies. Here you see structural transformation in employment. Yeah? And the typical, we call it the Kuznets curve pattern of development, is that at the beginning, when countries are poor, a large share of the people works in agriculture. In the beginning of the development process, then the share of employment in industry increases first. But at the later stages, industry actually starts declining and more people go into services. And the reason is simple. That has to do with the income elasticity of demand. The richer people become, the more they demand services, and the less they demand manufactured goods or in fact, agricultural goods. And what is here interesting about this chart is it compares, the green chart is the average pattern for the world. The red, the green line, the red line is the pattern for Asia. And in Asia, actually, you saw even more industrialization than in other parts of the world in the context of the development process. Not much more, yeah. So it's not a totally different development pattern, but it's significant enough that you can see this in the graph. This here now is not in employment. This is in value added. So in terms of production, these are production patterns. They follow basically the same pattern, same sort of inverse U-shaped pattern. And it shows you different parts of Asia, and you see that this strong emphasis on industry is a pattern especially of East Asia and of Southeast Asia. It's less a pattern of South Asia. South Asia is more similar to Latin America or to Africa, for example, in the development pattern. In East Asia and in Southeast Asia, you saw very strong industrialization in the process of development. So this basically shows where Asian economies were compared to the rest of the world in 1990. This is 2004. Yeah, you see how many of these economies have shifted to the right, so they've become relatively wealthier. And this is 2018. And I think what's quite striking is in 2018, different from 2004, many are already on a part of the graph that slopes downwards. That means they are beyond the path where employment and value added in industry typically peaks, where it now starts becoming smaller, and this share of services starts becoming larger. Now, if you want to look where your country is, this is the chart. You see that China, for example, is maybe slightly beyond peak industrialization already. Vietnam, for example, is slightly before. Of course, you have the wealthy, older Asian economies like Japan or Korea. They are already clearly in the services-dominated part. Hong Kong, of course, is a big outlier, a very wealthy but traditionally services-dominated economy. That's sort of kind of not the standard pattern you overall find in Asia. Now, what's also an interesting phenomenon is that industrialization closely developed step in step with trade. And you see indeed that in the period where Asian economies industrialized, also trade integration of Asia increased greatly, partly accompanied by policies, by great tariff reductions, including for imported manufactured products and for exported as well, but of course this is the policies of others. But as economies have become more services oriented, actually the depth of trade integration hasn't increased any longer in Asia. And why is trade so important? Trade is important because it allows you to go beyond your own production capacity, right? So, and that you show on the right-hand side. If you have a positive shock to trade exports, it allows building up production capacity in the sector in order to service foreign demand rather than domestic demand. So you have access to the entire world market in order to industrialize, and that can greatly accelerate the process of industrialization and of structural transformation. Now, but I said earlier that many Asian economies have reached peak industrialization. So, and they are now at the point where economies typically start moving into services. So what about services? This shows you the pattern of Asia compared to the rest of the world in terms of the share of employment in services. And you see, as Asia was above the rest of the world in terms of industry, it's below the average of the world in terms of services. That, however, does not mean that services in Asia have not been important. Yeah? On the right-hand side, we break down again how the share of employment has changed over time, how the share in agriculture has gone back. And actually, services have absorbed more labor freed up by agriculture in Asia than manufacturing. And that's a result that many people didn't expect, that we didn't expect, but it comes quite clearly out of this study. So development in Asia is already more services-based than manufacturing-based. And interestingly, a large part is what we call tradable services, like business and finance, things that maybe traditionally were not so tradable, but with the development of digital technology, they've become increasingly tradable, and that seems to have become a key force of development in Asia. Now, how does this structural transformation between sectors help productivity and help spur growth? Let's first look at what does it mean to move out of agriculture. Yeah? So if agricultural productivity increases, you can produce agricultural goods with fewer people. They're being freed up to move into different sectors. And you see, in short, if you see that these dots are to the left of the diagonal line, that means that a sector is less productive than the global average. And agriculture in Asia is less productive than the global average. While industry is not less productive than the global average. So you move from a disproportionately unproductive sector into a productive sector. It's pretty clear that this is something that's positive for growth. You also see this on the right-hand side. So the share of agriculture in value added is much lower than the share of agriculture in employment, continues to be, meaning moving out of agriculture must increase overall productivity for the economy and therefore be positive for growth. Now, what about productivity of services? And here I think we again have a few quite interesting results. On the left-hand side, you first have sort of a snapshot. In one specific year, what is the productivity of services compared to manufacturing? Here is manufacturing. Yeah. First, you see agriculture is below, we just showed that, but many services are actually more productive than manufacturing is, which suggests by itself that moving into services has probably even stronger growth effects than moving into industry, especially into traded services like finance and business. That's confirmed by the chart on the left-hand side. This is called unconditional beta convergence, economists call it. It basically means you establish a relationship between the level of productivity and the rate of growth in productivity. If it's negative, it means if you have a very poor starting position in productivity, that sector will go very fast. Yeah? And if that's the case, that sector has a lot of potential in order to produce growth. And we see that the sectors that have the strongest potential to produce growth and where this is actually a significant effect are again business and finance. So these are traded services. What is the bottom line of all this? I think there's a lot of apprehension about what does peak industrialization mean for Asia. Will we grow less if we move into services? And this analysis suggests no. Actually, if anything, if you move into the right services, into traded services like business and finance, there's tremendous and potentially untapped growth potential. I think this is my last slide with graphs. The left-hand side shows, I talked about traded services. Traded services in Asia seems really underexploited. Yeah? An average trade in services in Asia is less than trade in services in other parts of the world. That's exactly the opposite of manufacturing, yeah? Where Asia trades more in manufacturing than other parts of the world. Of course, it is the direct consequence of having smaller employment shares and smaller value-added shares in services. Therefore, you also trade less. There are a couple of exceptions. These are countries like the Philippines or India, which have sort of specialized in some traded services, but they don't suggest the overall pattern. The right-hand side shows you trade restrictiveness. How open is Asia to trade in different sectors compared to the rest of the world? It is very open in manufacturing. It is rather closed in agriculture and in services. And in our view, that means you are, if it stays like this, you risk missing out on growth opportunities. In terms of agriculture, because you miss out on productivity growth in agriculture, which releases the labor force to move to more productive sectors. In terms of services, because you forgo growth and export potential for productive sectors. Yeah, so this is a short summary. What do we think about growth in Asia going forward? There are demographic pressures. They will probably slow growth. It's why it's so important to have more productivity gains in order to partially compensate for that. One way to compensate for that is to boost agricultural productivity, to speed up structural transformation. That allows reallocation towards more productive sectors, but it also requires the right policies. So my last slide, what are the right policies? In very broad terms, equip people for the services economy, training and education. Reduce obstacles for structural transformation, for reallocating capital to different sectors. Increase trade openness in these sectors in order to be able to benefit from a global market and traded services from an Asian perspective. Now, of course, there are all kinds of other things that could come in the way. For example, AI, nobody knows really how this will work out. It will probably increase the tradability of services, so reinforce some of the tendencies that we already see, but of course it has its own effects. There are some sectors where AI may actually replace the existing labor force, other sectors where it may be complementary to the existing labor force, make it more productive. We have some specific analysis in our review that I want to repeat here. But what is pretty clear, if you miss out on digital readiness and forgo the opportunity to participate in the emerging market, global market for services, these countries are likely to miss out. I think I leave it here, and thank you very much for your attention.
Thank you very much, Johannes. Sorry for forcing you to finish everything in 30 minutes.
Did I?
But
I had no idea of the time.
31 minutes. But it's a wonderful set of slides and a lot of insight. And I especially like it's already on. The last few slides about policies, because I think going through all this empirical analysis. At the end, it is important for us to understand, what should countries do, right? And in Asia, there are a lot of debate about, whether they should further industrialize the economy or whether they should move to productive services. And I really like, the last few bullet points about how to sort of harness the transformation towards services, and services can actually deliver higher productivity growth. Unlike what many economists used to think, that manufacturing jobs are good jobs and create more productivity. I have two questions before I turn to the audience for more Q&A. The first question is about the long run, which is the easy one. The short question is about the short run, which is the more difficult one. The long run question is, people used to think that export-led industrialization is the key to economic success. Look at East Asian tigers, look at China. And today there are still countries like India or the Indian government that wishes to increase the shares of manufacturing and believe that the old path will be useful. And I'm glad that you mentioned AI. So my question is, this sort of inverted U shape, do you think industrialization is as important as before, or is it a necessary step for an economy, a poor economy, to become eventually at least middle income, if not advanced economy? And to add a little bit more to this question, manufacturing outputs used to create a lot of jobs, but now with automation and AI and everything, having more manufacturing output doesn't mean that there will be more manufacturing jobs. So for countries that are still stuck at low income services, how can they leapfrog to skip the industrialization process and get to the professional or productive services that you mentioned?
Yeah, these are big questions, and we try to address some of them in this analysis. I think that's why we went into the project. So, if I understood correctly, first question was sort of lower middle income countries. Is it necessary for them to industrialize, or can they leapfrog that and go straight into services? I mean, I think I have two comments on this. One is, again, it depends how far advanced the country is already. So I think countries like, for example, China, are certainly at a stage where it becomes a very acute question, whether there's really more potential in terms of pushing industry further, or whether there's more potential in opening up to services, and which requires structural changes in the economy. In other countries like India, I think the traditional Kuznets pattern would suggest that there's still scope to industrialize. I think you would also observe, however, that services, and we don't show this in this presentation, but services as a part of the world economy has become more important over time. So if you look at the traditional Asian growth model, maybe started with Japan in the late 19th century, then emulated, for example, by Korea middle of the last century. In a way, industrialization was the end point and services were an afterthought. And we don't live in this world anymore. We live in a world where the share of services and value added is much larger than it used to be. So I think that raises the question, is how important is that intermediate step of industrialization still? I don't think I have a definite answer to that. It is certainly less important than it used to be, but I think it would be a stretch to say that is not important. So yeah, but how much economies want to push that? I mean, of course, it also depends on things like comparative advantage. There's a lot of debate on, as you probably know, should India try to emulate China, try to become a second China? Many people say that's not possible. It's not possible because India's comparative advantage is somewhere else than China's is, and it lacks infrastructure, for example, to emulate it. But it has has a much stronger comparative advantage in services to start with. So the other question I think that's relevant is employment, of course. So I talked only about growth and productivity, but an open question is how many well-paying jobs will the services sector create? Will that be highly concentrated, or will that be spread more broadly? And I think there are concerns, for example, among policymakers that, yeah, okay, services may be good for productivity and growth, but it may not be good enough for employment. I should say, though, we haven't looked into that yet. So that's sort of something we left for future work and for future research to see how whether services can be as employment intensive as manufacturing. I'm not sure that answered your question, but I hope it...
No, these are tough questions. I agree that there needs to be more research to think about what manufacturing can do to developing countries these days. So my second question is about the short term, meaning the next 1 or 2 years. You mentioned that you're going to update some of the slides by the end of this week. And I guess, this is in response to the new, outcome in the US election. I actually struggle to understand why the US dollar started to appreciate, in the last few hours against, the Asian currencies. Because, and I guess on this, Vincent can add a bit about, Trump's personality or understanding about the economy. Because on the one hand, he, at least in the last few months on the election trials, that, he's going to impose higher tariffs on China and also the rest of the world. At the same time, he wants to lower interest rate further. And both of them is going to basically exacerbate the inflation, which probably suggests the US dollar is going to depreciate. But then, of course, there's a risk premium that is largely reduced due to, removal of the election uncertainty. And then, on the other hand, which is going to suggest stronger dollar because, the US economy is probably likely to strengthen because he's going to cut tax, especially for the rich, and therefore, at least in the short run, the US economy will be strong. So, help us to understand all these conflicting ideas. Is the dollar going to be strong or not? Is inflation going to increase or not? And then the more difficult thing, if you may, or maybe the audience will ask it anyway, is what will be the implications for Asia?
So on why the dollar appreciates in the short term, I'm not a currency expert, and if I would be, then I probably would not be sitting here, but would be have placed the right trade a few hours ago and be rich now. I'm sure the people in the audience who could answer the question better than me. My impression is the dollar appreciates if people expect a higher short-term growth in the United States. It's short-term. It's very much based on growth expectations. And my rationalization would be the better short-term growth expectations, next 3 to 6 months maybe, that maybe would slow down the Federal Reserve in terms of their cutting cycle in the next few months, also because of an inflationary risk potentially. And that would support a stronger US dollar. I think that would be my take on it, but I guess it's as good as anybody's. Now, what does Trump mean for Asia? $100 million question or $1 billion question. I think at the IMF, since we are an international organization and we try not to sort of get partial into country-specific policies, we prefer not to phrase it this way, but we sort of would go more sort of to maybe the policies that you would expect. Trade fragmentation, yeah. Certainly, if you get much higher tariffs, we see this clearly as a negative for longer-term growth, and it's certainly a negative for regions very much integrated into global trade, global supply chains. So Asia, Europe are probably the first candidates that you would think about that could suffer from this. I think another thing is not so much the tariff levels, but the uncertainty surrounding it. So the uncertainty surrounding trade policy, it just makes it much more difficult to plan what to produce and what to produce for exports if you don't know whether you can export it 6 months down the road or and that by itself is also net negative, certainly. But I think that's sort of the immediate off-the-hand assessment. So yeah, I think for economies strongly integrated into global trade and administration that is not necessarily pro-trade is probably not good news. Yeah.
Great. Let's open up for some questions from the audience. We have 15 minutes. Anyone? Great, in the back. And please, one question and try to get to the question quickly.
Hi, Johannes. Thanks for your brilliant presentation. So my question here is, you have outlined in your presentation that infrastructure is always important for emerging economies, especially in Asia. But also, I think it is very important to have the right balance of like how much infrastructure do you want. For example, like if you're looking at Sri Lanka back in 2022, they built a lot of white elephants and got into huge trouble and had to be bailed out by the IMF. So my question here is, how do you think, like especially in the emerging economies and in Asia Pacific, how should these emerging economies treat infrastructure as an investment? And is there like a good ratio or rule of thumb to see how much should they invest in, even though we know that they're underinvested?
You want to take a few, or should I answer directly?
Maybe one more, and then two questions at a time. One more.
Thank you very much. Very interesting. I'm going to follow up a little bit on Haywai's question, especially regarding trade. You've talked about trade restrictiveness. You've then recommended, understandably, that Asian countries should open up their markets, apart from agriculture, which everybody restricts, services and manufacturing. What are your views about what's happened, not only with the U.S., but with Europe as well? Is that going to put pressure on Asian countries to either slow down or perhaps even reverse in some cases their openness, especially in areas like manufacturing where they've made so much progress? I know it's speculative, but I just wondered if you think it makes a difference.
Okay, let me try to answer both difficult questions. On the first one, I'm not sure there's a rule of thumb, sort of what's an optimal level of infrastructure investment. I think part of the answer you gave yourself, it's not only the quantity, it's more the quality of infrastructure investment that matters, and whether it's complementary to private sector development needs, which ideally it should be. And yeah, building white elephants, prestige objects, they probably don't generate too much growth, but a stronger transport infrastructure, investments that enable countries to participate in the global digital economy. I think, if they're well thought out and well implemented, I think that you probably would expect them to contribute positively to growth. It's very interesting because in my own country, in Germany, we have a debate these days that we have underinvested in public infrastructure for the past 20 and 30 years, and that this becomes a significant drag on growth potential. And I think there's probably something to it. On the question about trade, so yeah, we observe, of course, the global increase in trade restrictions with concern. It's widespread across the globe. It's really everybody who, and in a way, putting in trade restrictions becomes kind of a new normal. So there are many policies which don't maybe even target trades, like industrial policies to promote certain sectors, which, however, have trade restricting and trade distorting elements. And I think our advice is, if you implement these measures, to check them carefully that they don't have unintended consequences. Like, for example, reduce your ability to participate in global trade and therefore benefit from global increases in productivity. Yeah, but I mean, overall, I think it's natural as a multilateral economic institution, we are not a fan of these developments. But it seems a very strong force, and there's no change in trend in sight. So we'll see how that plays out. And of course, it makes it more difficult to open yourself up to trade and, for example, to services trade and harvest the opportunity that, for example, a global services economy may entail. It certainly makes it more difficult.
Great. Any more questions? Yeah, KC, and then there's one over there.
Thank you for the presentation. I just want to go a little deeper on this services trade liberalization in Asia. If you look at around the world, the biggest items of services trade are typically things like transportation services, financial services, maybe a bit more increasingly in computer IT related services. And then for most developing countries, the thing they could really work on is tourism. Because at the end of the day, financial services, transportation services, globally, they're basically dominated by the big guys. So if Asia really wants to liberalize trade, what are some of the key sectors they should be focusing on?
One more, the gentleman at the front. Yeah.
Thank you. I want to talk about emerging Asia. I've seen Fiji on your slides, and there's one key economy, Papua New Guinea. How does economic transformation look like for Papua New Guinea, who is challenged with agricultural remoteness and highly dependent on mining and electricity generated by fuel?
Okay. So, again, both not easy questions to answer. So, on services trades, our empirical results show business and finance are particular sectors where there's great upward potential in terms of productivity and benefiting from greater global trade integration. Now you say that's already basically dominated by others and there's little space to grow into. I'm not sure that is true. It's a bit difficult to disentangle cause and consequence here. So if you start being closed up to trade in these services to begin with, then of course you have a weaker starting positions. Doesn't mean when you open up that you wouldn't be able to find your niche and grow in that niche. I know that's a fairly abstract answer, but I think for me the key is what is cause and what is consequence. So is the small share of Asian economies in global services trade the consequence of past policies, and if these policies change, that could also change, or sort of has basically the world been divided up and there's no opportunity to grow into. I would probably tend more towards the former view. But at this stage, I think that's what I can sensibly say about that. Then, how would be growth for Fiji and Papua New Guinea? As I'm not sure I have a very good answer to that. Fiji, of course, Pacific island economies and island economies in general have, of course, great restrictions on being able to grow, not only in the Pacific, also in the Caribbean. Or I think my very first country to which I led a mission at the IMF was an island economy in the Caribbean, and they all have issues with no economies of scale. Everything is very small. Therefore, you have high fixed cost in everything that sort of make you uncompetitive. But maybe for these economies, if services become more tradable, that's also a growth opportunity for these. Of course, it requires that you produce the right skills, and of course, that's also difficult if you start very poor. But could be a potential growth avenue maybe for them. And Papua New Guinea, to be honest, I don't know enough of about the country to give you a very strong or qualified answer. But I think the bottom line is, of course, fully acknowledge that for some countries, the starting position is very, very difficult, and they have higher obstacles to growing than others. And probably the two countries you mentioned fall under this.
Two hands, three questions, I guess that's enough. So Chimei first, and then this gentleman in a white shirt later.
Hi, thank you. My question is about migration. Don't you think immigration liberalization might have a much higher impact than trade liberalization, given how low migration is within Asia? If you just compare Europe and North America, in my view, that's the missing element of structural transformation. Have you looked into this? What do you think about movement of goods versus the movement of people?
And one more, this gentleman in white shirt.
Hi, I just have a clarification on your first chart. I think for India there was a huge light blue color graph that said statistical discrepancy. Now, is that IMF fudging, or what is it?
Okay, I have an answer to this, but yeah, okay.
Maybe one last question here.
Thanks for your presentation. I'd just like to ask how rising geopolitical risks and protectionism are going to affect your outlook, because I don't think you have mentioned about the risk there. And actually, the morning seminar I went to, 2/3 of the investors are very concerned about geopolitical risks. And somewhat related to protectionism is the income inequality. You talk about growth, but more importantly, the reason why the advanced countries are having more sort of protectionist measures because they think they're losing out, and that somebody is grabbing the job. Now, I don't agree with this, of course, but as an economist, but this is what the world trend is about, and probably still going to dominate. How do you sort of see this playing out?
Thanks. As a first on migration, I agree with you. It didn't come up in the presentation. Like, for example, migration in principle is a great way in principle, to offset demographic headwinds. We don't mention it that much here. Partly, in an accounting sense, is obvious. In practical terms, it's often very difficult for countries to formulate coherent migration policies, and often also creates really strong reactions when you talk about this. The language barriers, the cultural differences, there's in some countries lack of acceptance of migrants that make it more difficult. But in principle, if your own population is old and doesn't produce income but demands services, I think some of them also non-traded services that you can't buy in international markets, then the obvious answer to that would be to have inward migration and provide it this way. But I think always being aware that this is easily said and much more difficult to do. Then on the statistical discrepancy of India, that comes from the fact that India produces two GDP statistics. One is supply-based and the other one is demand-based. Our team trusts the supply-side data more than the demand-side data, but only with the demand-side data you can do the kind of decomposition that we showed in the chart. So whatever is left over is statistical discrepancy, which sometimes can be quite large in Indian data. That's what I know about this, and we rather show it transparently than sort of pushing it under the rug. And then your question, I think, was in many ways a comment that I agree with. I think, of course, geoeconomic fragmentation is worrisome, and it's a much more uncertain world than, it feels at least like a much more uncertain world than 20 years ago, or maybe even 10 years ago, and uncertainty in general is not good for growth. I'm not sure what much more one could say about this. I think that's of course I'm worried. I think probably everybody in this room is worried about this, and I'm no exception to this. Yeah.
Any more questions? We can probably take one more. If not, actually, let me twist the last question about geopolitics and turn it into some new opportunities for Southeast Asian countries, right? I mean, in one of the charts it shows China's export has increased to emerging markets in this part of the world. And we know a lot of that import were further processed with export back to the US or Europe. So with potential higher tariffs imposed by the US government on China, maybe those countries are going to benefit even more from redirection of trade between China and the US. What do you think about that?
First, it's a phenomenon that we observe as well. So we had one graph on that shows that. I think, and it's possible that some countries who position themselves or are positioned in a very fortunate way can sort of, at least in the short term, benefit from trade frictions by attracting some of the trade that otherwise would have bypassed them. I think I have two observations. The first one is we see that trade in value added changes much less than nominal trade. And what does it mean? It means that really only a part of the supply chain is shifting. Yeah, very often the increased trade that we see is that something that used to be exported from China is still produced 80% in China. Then for the last 20% it's shipped to another country, and then this country adds the last 20% and then exports it from there. And that means the welfare effects are much larger than much smaller than nominal trade flows would suggest. And then the second thing is, from a global perspective, that is just cost, right? This is just a deviation of, this is a detour of trade flows. It adds transaction costs. So for the world economy, it must be negative. Whether individual countries can benefit to some degree, yeah, it's certainly possible. We did some simulation exercises that shows ultimately everybody loses. I mean, that's in a way a nice result to communicate. Not sure that really necessarily holds in every single case, but that the world economy overall would lose, I think that's clear.
Great. With that, final question. Thank you so much to you, Dr. Wiegand. I know you will be going to Shenzhen and the rest of mainland China to present this report, and I hope you also get some new discovery about the Chinese economy, because there are some new policies, and maybe on the way back you can tell us whether those stimulus are going to be useful for the Chinese economy. Thank you very much. A comprehensive presentation, and thank you very much.